Time to look at some numbers. In the last video, we covered quite a bit regarding policy loans. We went through fixed loan interest rates, how different companies have different fixed rates, variable loan interest rates. How variable is a variable loan interest rate? That was a lot of fun. What we're going to look at in this video and the next several videos are some numbers, and we are going to have fun. We're going to provide a lot of additional information. This way, if you're considering a high cash value life insurance policy, perhaps you already have a policy and you're wondering, what does the policy look like when I actually take loans? In this example, in the next several examples, we're going to look at a 40-year-old individual. We're going to look at a MassMutual 10-pay in this particular video. 100K per year for 10 years. 10-pay product with MassMutual is maximized for internal rate of return. $500,000 loan coming out. And then what does it look like if I repay that 500K loan in full? What does it look like if I don't repay it? What's it look like if I only pay the interest? So we've got those three options there: repay, interest only. So I'm only going to pay the interest each year indefinitely in this model, and then I never repay it. Life happens, or I simply decide I don't want to pay it. So MassMutual, if we elect their variable loan interest rate, I will have a non-direct recognition policy. So this will be non-direct recognition. What that means is that 6% dividend interest rate will be applied to my full cash value, any money in cash value, and also what I have borrowed against the policy. No lost opportunity cost. That 6% dividend rate is constant. And remember, dividend rate is never what I'm actually earning. The internal rate of return, in the life insurance industry, this is the terminology or term I want to ask for if I'm working with an agent to show what is the net growth rate on cash value. And I can look at the annual internal rate of return and also the average internal rate of return. Why I mention that in this particular example is we do have a dividend interest rate of 6%. That's MassMutual's 2022 dividend interest rate. We have a variable loan interest rate of 3%. So a lot of people would look at this and say, I've got a 6% dividend interest rate I'm earning on my entire cash value and a 3% cost to borrow. That's a positive 3% spread. That is fantastic. It is fantastic. However, to pull things back to reality a little bit, 6% dividend, you'll find on the internal rate of return might top out right around 4.5%. On the average over time, the annual IRR will top out just about 5%, assuming that dividend holds steady forever, but I won't see a 6% earnings rate. And this is a variable loan interest rate, which can adjust how often for the policyholder. In our last video, we covered this one time per year on our policy anniversary date. Depends on what the insurance company's variable loan rate is on our anniversary date. So let's look at some numbers. We're going to study these three scenarios. So before I just dive into the spreadsheet, actually, I do like to validate things. So why don't we do this? I'm not going to go through every full illustration, but anytime we're looking at loans, if you're working with someone who's attempting to simplify it for you, and an Excel spreadsheet will simplify things when we look at these stereo instructions in a second. But if we are looking at something that is not the formal illustration, what I would always request or make sure that you're receiving this is the actual illustration as well. Because what's important is to make sure that an Excel comparison sheet or a third-party piece of literature, if we're pulling the information from the illustration, those values should be identical, which is exactly what we do when we put these models together. It can be time consuming though. So from the consumer's perspective, if you're looking at this and interested in a policy, the question I would ask is, hey, thank you for the simplified model. Can I see the detailed illustration as well? And you don't have to go through all of this. I would just reference the cash value and death benefit columns and make sure everything matches up. You will see everything flow together, but just from an awareness perspective. So why I don't like the detailed illustrations when it comes to loans is here we've got our annual outlay. And if this was just a policy without loans, 100K per year for 10 years, that's what he's actually paying into it, we would see what we see years 1 through 5, years 1 through 10. What happens year 6? This is fun stuff, man. Year 6, we see negative $400,000. Well, the reason why is we take an annual loan here of $500,000, 500 grand. The annual outlay column, which is based on the software when we actually put this illustration together, is assuming the $100K payment. So if this is you, it's assuming you paid $100,000, then you borrowed $500,000, so you received 500 grand from MassMutual in this particular case. That's why I see negative $400,000. Beginning year 7, what do you notice here? Your premium and PUA payment is still $100,000 per year, but we see $115,000 going in. The reason why is if we take that $500,000 loan balance, this particular illustration is the pay interest only scenario at a 3% loan interest rate. 3% of $500,000 is 15 grand. So what you can see here actually is after the 10-year funding period, I'm no longer making the $100,000 per year payment. I'm only paying the loan interest. And in this particular example, we ran that indefinitely. If we look at the design of the policy, went a bit too far. There we go. 10K base premium, term insurance rider, a little over $1,300. It's a renewable term rider, but with MassMutual, that is level for the first 10 years. And then AILR, just dumping everything else into PUAs. MEC limit, 102, just about 103 in this case. So we've got a minimum death benefit based on the amount we want to pay in. So let's take a look here. What do we got? On the left, this is one of my favorite things to do when examining loan scenarios. Look at the growth model first. If I just pay the money in and let it sit and grow, what does it look like over time? First year, 100K in, 89.5 in cash value. This is based on a 40-year-old male. The health rating, when we go back to that, ultra preferred, so the best class in this particular example. Let's go back. Come on, there we go. So what do we see here? First year, 100 in, 89.5. If this was select preferred, that would be about 89.2 to 89.3. Not a huge difference. If it was non-smoker, it would be high 88s, 88.8 or so. 100K per year for 10 years, nothing thereafter. Just let it sit and grow. Yellow, what's highlighted in yellow represents the break-even point. Now, when we look at this guy, this is the loan and repayment scenario. So instead of just jumbling it all together in the annual outlay column, I should have called this premium and PUA column because that's what this is. But I think you'll follow what I'm doing here. Exact same outlay as what we have over here. Then we've got our annual loan. Year 6, we borrow $500,000. We can take policy loans anytime we'd like. Whatever we have in cash value determines the maximum amount we can borrow against the policy. So if in year 1 I have $89,000, I could take a maximum loan of anywhere between $85,000 and $89,000 and change. Depends on how big the term rider is, a couple other factors, but it'll be anywhere between 98, almost up to 100% of whatever I have in cash value. Or I'm sorry, between 95 and 100% of whatever I have in cash value. In this example, year 6, $500,000 loan. And what we did in this particular example is because we're still paying into it up until age 50, which is what he wanted to do, we did not want to assume that he continues to fund it at 100K per year and repays the loan principal at the same time. Instead, he says, I'd like to continue to make my payment. There's the 100K per year. The $500,000 loan, I can't pay that back right now, or I don't want to. What I can do is pay the loan interest at a minimum. So here, loan interest rate is 3%, $15,000 per year. Interest payment, $15,000. If we see purple, that represents our additional out-of-pocket. So in reality, year 6 here, we put this in gold. If this is you, your true out-of-pocket was what? 115K, because you paid the 100K payment, premium and PUA payment, and then another $15,000 toward loan interest. So we do that each year up until year 10. And at this point in time, beginning year 11, you pay the interest, plus you apply $100,000 toward the loan balance. So what we did was just redirect the money we were paying toward premium and PUAs, and redirect it toward loan repayments. We do that each year, and we pay the loan interest out of pocket each year as well until it's paid back. What do you notice about the cash value death benefit when it is paid back compared to the example where I just let it sit and grow? Year 15, let it sit and grow. What do you have? 1507, so just over 1.5 million. Death benefit, 2.55. What do you see on the far right? Identical values. Because this is a non-direct recognition policy, the dividends and interest applied to the policy are identical across the board. I'm still earning dividends on my full cash value as if I never touched it in the first place. Now, what I do want to hit on, I forgot an important piece. When I borrow the $500,000, there's your cash value reduction, because that's the gauge that determines how much you can borrow against the policy. Then your death benefit will also drop dollar for dollar in this case. I circled year 5 over here, and year 6. See that difference there? Was 2.476084. Look at that, 0.84 to the dollar. So I see that $500,000 reduction. So when I repay it, if I repay it, in this particular case, with a non-direct recognition policy, I'll see my values fully restored. In this example, we assumed the loan interest rate never increased. Likely, I think not. However, that's the model we looked at here. In the next couple of videos, we're going to keep on increasing the rates. We're going to look at fixed rates and such as well. But here's what we want to look at here. Here's what I would be interested in, is what is my total cost to borrow? When I say cost to borrow, really, if I just tally up my interest payments, what did I pay in this particular case to the insurance company in total loan interest costs? So if we look at this guy, let's just zoom down here. There we go. So first year, paid 15 grand. Next year, 15 grand. Remember that we just paid interest only for 4 years in this case, not applying anything toward the loan balance. So I'm doing this to free up cash flow so I can keep pumping it into my policy. And here I go. Total interest expense, 105 and change. Another thing we could look at here is what is my net earnings rate? Because your cost to borrow is what? 3% flat. Let's take a look here. Beautiful. I love it when a plan comes together. So the annual IRR, we can do real quick here. The average I've got to pull from the software. But a lot of people are interested in this right here. What's my annual internal rate of return and average? What's the net growth rate, more than anything else, compared to the net cost to borrow? If it's 3%, and it's 3% constant here, we would measure this each year if it's variable. What I would look at is, okay, when am I positive? Year 5 in this particular example, assuming the dividend rate holds and that IRR is consistent, and it also assumes that the variable loan interest rate does not adjust either. If things adjust, we would measure it year over year. Many people do decide to access their cash value via policy loans before they see a positive IRR, and really the most important thing there is just awareness. Meaning, if year 3, I'm at 1.5% and I can borrow at 3, what's that come out to? About 1.5 points cost when I really look at the numbers there. And you can look at, hey, you're still earning this IRR on your entire cash value and paying the loan interest only on the remaining loan balance. People do like to consider that, so we like to consider all options. But again, more information provides more awareness. We do not mean to be analysis paralysis, but this way I understand it and I can really drive as fast as possible with my cash value life insurance policy. Let's look at no repayments. So this one is pretty straightforward. Same policy compares to the same loan scenario. $500,000. Year 6, the outcome is identical. What do you notice here though? Year 7, balance grows to $515. In the last example, we held steady at $500,000. Remember why? Because we paid the loan interest each year. Here, it's $15,000 the first year, but then what's 3% of 515? Comes out to $15,450. If you do not pay the loan interest on the anniversary date, it will compound. The policy will loan against itself to cover that loan interest that's due. That's added to the balance, and then the loan interest is calculated on whatever your total loan balance is. So loan interest accrues at simple interest only over the course of a year. So we have that term, annual simple interest, is how loan interest accrues on life insurance policies. That is true, annual simple interest, only over one annual year. That doesn't really make sense, my verbiage there. That might be a double negative, but you know what I mean. I hope at least. As we look at this guy though, we assume we never pay any loan interest. And what do you notice? Compound with the balance. Now in this particular case, we'll easily outpace the loan. Our cash value continues to appreciate. But what do we notice here? Let's look at age, let's go down a while actually. Let's look at age 80. Cash value, if you don't touch it, is what? Almost $5 million. Death benefits getting close to 6. Here we go. What about on the right? 1.365, that's my outstanding loan. So I took a $500,000 loan, and over the course now of about 34 years, it's compounded to 1.4. I don't have to pay it. Especially in the case like this, if I continue to see positive appreciation, I paid in $1 million and I borrowed half of it, so I will see it outpace in almost every scenario. The cash value will outpace things. But what do you notice over here? Cash value is about 3.6. If you were to pay that back, guess what would happen? Be restored to this value. Now the death benefit, anytime you look at a life insurance illustration, if you see the terminology net death benefit, which is what this is, that does account for the loan. So if I were to die at age 80, and this was my policy and everything performed exactly according to this projection, that would be the net payout. My beneficiaries would get that. Because what that value reflects is this death benefit minus the 1.365, that's the net payout. So we can crunch the numbers and say this one makes more sense. Some people will just look at this and say, hey, I paid in $1 million, but then I took $500,000, so I view it that I paid in a net of $500K, and this is what I'm leaving. That's great. I would look at a more conservative illustration though, personally. But this is the no repayment scenario. We'll see that it continues to produce positive appreciation, never lapses. I would have to borrow a lot more to run into that type of risk. But then let's look at paying interest only, which again, same scenario, but we're going to assume that we cover the loan interest out of pocket each year. $15,000 due, $15,000 paid. The nice thing about this, if we go down to age 80, you're going to see a similar pattern here, particularly if we pay that loan off, $500,000, add 500 grand, 515 to the cash value and 500 to the death benefit, and guess what you get? There you go. Total values as if you never touched it in the first place. So this is really a best case scenario, 6% dividend interest rate, which gave us an annual IRR that topped out at about 5% with a variable loan interest rate of 3%. Is that realistic over a long duration of time? Personal opinion, no. Just looking at the history of life insurance and measuring actual IRRs compared to loan rates. But at the present, it's not bad at all. Things do change over time. But it's a best case scenario with a non-direct recognition loan. As we progress through each video, as we look at the next one, we're actually going to look at the same product, same 10-pay policy. We're going to keep the loan interest rate variable, but we're going to kick it up to 4%. This way we can see the impact. How much more do I pay in interest? When I look at that spread on the annual IRR, how much longer does it take for me to be positive? Because while we will increase the variable loan interest rate, we will not increase the dividend rate in this particular case, which we don't always want to do that. If interest rates go up, variable loan rates typically follow. If dividend rates do increase as well, meaning assets become available that the insurance company can acquire and that supports their dividend, what happens, or typically what you see just when you look at history, is there is a lag there. It takes a number of years before we start to see that increase, where this does not increase. So again, not that that's necessarily a bad thing. You might look at it and say, it doesn't make sense for me to do it in that case, but just having the awareness on that helps a lot before I put my money into any type of product. So, hope you enjoyed this one. I sure did. If you have any questions, would like to see any custom illustrations, or reach out to us anytime, or would like to talk to us, please feel free to reach out. If you enjoyed the video, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.